Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
All right, welcome to Market Call. We're going to get your market stuff all right in one show here, Liz. How are you?
Yep,
Liz,
I hope so.
We're going to do it all here. Guy Adami is taking a little well-deserved breather. You and I are going to tackle what I think is a pretty interesting week here. We start, we got some interesting action. You and I are going to go through it a little bit about what we're seeing today, maybe a little narrow breath. Let's throw the rundown up here really quickly. Liz, while you don't have a note out this week, you're going to run us through a little bit of seasonality stuff that you're seeing in the market. We're also going to talk about some strategists and some of the observations they're making about the high bar for Q2 earnings. This is something that we have not seen if you just track some of the data from Butters over the last few quarters. And then tomorrow morning, we have Q2 deliveries from Tesla, and then we're going to take some questions. Liz, so I said, interesting week. We got Fed Chair Powell tomorrow speaking. We end the week after a holiday, which would be July 4th, with the non-farm payrolls, all right, from May. But most importantly, I think there's a half day on Wednesday to celebrate a very important birthday.
Yeah, of course.
We have a birthday on July 4th for America, and then
Right.
on July 3rd, we have a birthday for America's favorite stock market strategist. That would be you, Liz Thomas from SoFi.
Yes, 42 years young. I'm not there yet. Still hanging on to it.
I love it that you are not afraid to throw that number out. Many women just don't like it. I mean, you're doing great for 42 there.
I didn't say I liked it, but what's there to hide?
No, I
people
got
can
you.
figure it out.
All right, let's get into the markets here. One of the things that's really interesting, and again, you've been gone for a little bit. You were on just to throw it all out there on your honeymoon, which was absolutely sounds amazing. I went to Machu Picchu, I want to say 20 years ago or so. It's kind of an epic trip. It's not one that's on most people's bingo card. Talk to us. Give us a 411 on Cusco, which is kind of the landing place. You probably flew into Lima, then you went up to Aguas Caliente, then you walked around Machu Picchu. Was it everything that you expected?
It was more than I expected, honestly. So we spent 9 days total in Peru. Probably 4 or 5 of those in Lima. But then, as you know, to get to Machu Picchu is like a days-long process. You have to fly from Lima to Cusco, and then you got to take a train. Our train was 4 hours from Cusco to Aguas Calientes, and then you can go to Machu Picchu. And I was telling you before the show, I'll tell our listeners now, because it's like such a buildup, before we got to Machu Picchu, I was like, oh God, what if we get there? And I'm like, that's it. I'm totally unimpressed and uninterested. So I was nervous. And as soon as we walked in, there's like this little pathway that you walk through and it all comes into view. And I was absolutely awed. It is one of the coolest things. I mean, it's a wonder of the world for a reason. It is one of the coolest things you'll ever see. And we walked around it. We took a bunch of pictures. And yes, the little towns that you have to go through in order to get there are an extra cool part of just the journey. Cusco is amazing. Aside from the fact that I struggled with the altitude and was huffing and puffing up and down very small hills.
No, the altitude is really tough. My wife, I remember, had a difficult time too. And the Peruvian people are about as nice as you can find.
Oh, they're so nice.
Yeah.
And the food there, I had no idea how good the food. I mean, it was like every meal, and even the meals that weren't amazing, they were good. It was just like the most amazing food, great restaurants. The produce is delicious. The people are so kind. It was a wonderful trip.
All right. Well, we're happy to have you back after 9 days. So I'm glad you guys had a great time. All right, let's get into this. One of the things that I thought was interesting is funny. My friend Doug Cass over there at Seabreeze, he sent me something on market breadth on narrowing, and I was looking at the exact same stuff. He was talking about the advanced decline. I just want to throw this up here a little bit. I was looking at the top 10 stocks in the S&P 500, which make up close to like 33, 34% or so. And it's interesting. So there's the New York Stock Exchange, the NASDAQ advanced decline. You see that decliners are pretty much outweighing, the advancers here. But look at the top 10 here. So there's only 2 stocks down, and you look at the ones that are up. I mean, when you see Apple up 3%, you see Microsoft up 1.7%, you see Amazon up 2%. I mean, these are big moves in big stocks, which are really crowding out a whole heck of a lot of other stuff that's going on in the markets. Give me your 411, Liz, on this. Does this say the same thing to you as it does to me and someone like Doug here? Is that we're starting to get narrower and narrower, and maybe it's because rates are going back up, and we're going to hit that a little bit. People are kind of rushing back into the mega trends and the names that they know have the biggest moats and the biggest balance sheets and all the like.
Short answer is yes, but I don't think that it's something that's terribly concerning at this juncture. I mean, these are all the usual suspects. It's literally every single name that we've talked about for most of the year as driving the market, maybe with the exception of JP Morgan, but even that, we've talked so much about the big banks and some swings that we've seen in them, and they've seen this revival since the end of last week. So what this says to me is, again, investors have this muscle memory that even if things are getting a little choppy, even if valuations can't be justified, even if yields are rising, all we do is go back to Old Faithful. And Old Faithful is most of the names on this list. And you know what? They're not wrong, because it has worked time and time again. When we have those rotations and you hear this commentary about everything is broadening out, it's because the economy is stronger. It's because we've secured our soft landing. And then we hit the skids a little bit. You go back to these stocks and they do really well. The thing that has not happened this cycle, or not yet happened this cycle, is that even when things start to get choppy, or even when we start to worry about frothiness in the market, money doesn't come out of equities. It just rotates within. And we go back and forth between this really narrowly led market and into maybe a broader market. But there are still things that don't ever quite get off the mat, and they don't ever quite break out. So I don't think that this is necessarily a harbinger of something terrible to come. I think it's just repeating the same patterns.
Yeah, I guess the one thing I'd say about the rotations is that rotations within tech, we saw that last week out of semis into software, and that kind of did what it needed to do to keep things fairly well bid. The S&P, I think on the opening on Friday, was very near an all-time high. And so you say to yourself, okay, if those top 10 names in a broad market sell-off were all to go down, it doesn't matter if you rotate into energy or into, some other defensives, utilities or staples or that sort of stuff, because that's when correlations are going to go to 1. And, again, we haven't had a 10% sell off from a high since last July into last October. We know how much we've rallied since the lows in last October. I just want to pull up the S&P chart here. When you look at this, you see this uptrend from the October lows, right? You see a very nice 45-degree angle. You also see an S&P that is about 11% from its 200-day moving average. The S&P is up about 33% from those October lows. So again, you got nothing to worry about from a technical standpoint until the S&P tests that uptrend. But I will say that spread between the price and the 200-day moving average, rarely do you see it that much above 10%, Liz.
Yeah, there was actually a note out from Strategas. It was either today or on Friday about the number of stocks in the S&P that are still above their 200-day moving average. And that percentage is still about, I think, 65, 66%. You want that percentage, according to them, to stay above 60%. Otherwise, you enter the time when it's really more amenable to make this story about it's very narrowly led. So as long as there are 65, 66% of stocks in the S&P still above their moving averages, that shows that there is at least some strength under the surface. But to your point, if this gap starts to close, and if the S&P starts to retreat back down toward its 200-day moving average, which, by the way, wouldn't be that big of a deal, right? We haven't had a 2% correction on a day for I don't even know how many days now, 350, something like that.
No, it's above 380, Liz. I mean, it's
incredible. Yeah. Incredible. So wouldn't be a big deal, wouldn't be a huge problem, even if the S&P did start to retreat back down towards its 200-day moving average. What would be a bigger problem is if you saw stocks start to come off of that list. So you start to see stocks dropping below their 200-day, dropping below their 100-day. That's where you have a narrowly led market. We're not there yet, but we certainly could get there if we hit some bouts of volatility.
Yeah, and I'll just throw up the equal weight S&P. That's the RSP, and you look at this, it's up about 3%. So again, 3% for the equal weight, and I think the S&P is up 14.5%. Those top 10 names, like I said, make up 33% of the weight. So when you look at this RSP, you see it below that uptrend that had been in place since October. You see the last few weeks of it grinding a little bit below that uptrend. Again, that's just purely a technical thing. But today, through the 100-day and the 50-day. So again, this speaks to the lack, in my opinion, of breadth that we're seeing. So if you were to see that number, okay, of stocks above their 200-day, right, below 60% or so, I'd get a little nervous, because this is going to lead to the downside. And then if you see those large cap names catch up, I just don't know why people don't think what happened last summer. And I know you're just thinking to yourself, I know what you did last summer. There you go. That was one of your faves from the 90s, wasn't it? But
no, Scream. I was a Scream gal.
I know, but that's something that could just happen, and it can happen all at once.
Sure.
And one of the things I'll just say is that when you look at some of the shoot first and ask questions later, maybe they could pull this up really quickly. Remember, Netflix right out of the gate had a big gap lower when it reported its Q1 results. Then we had Meta. Then we started off with JP Morgan. Well, all those stocks filled in their gaps, and then some. Maybe they can just kind of look at that gap right there. That was Netflix as far as it was in tech. We'll pull up Meta here too. Meta, had that huge gap lower. Look at that. Well, that's JP Morgan making new 52-week highs today. And then there's the Meta gap, and it's very near its prior highs. So again, I just, I think that some of those cracks that we saw at a Q2 guidance, and this goes to some of the expectations on earnings, and we're going to hit that in a second. I think they got a little high, and you'd rather see expectations low, Liz. Wouldn't you agree with that? Heading into an earnings season, especially with S&P very near all-time highs, than with expectations very high. I think she froze here a little bit. I think you could know where I'm coming from on that. I just want to hit a little bit before we get her back. Hey, Liz, are you back there with us?
Sorry, I don't know what happened there.
No worries. Did you? All right. So the last point I was making is that expectations for Q2 earnings are fairly high. And I just want to pull this note up. This is, I think, from Costin at Goldman Sachs here. And they're just talking about how year over year expecting 9% growth. We track Butter's work pretty frequently, and usually we see earnings estimates come down over the course of the quarter. Last week in his earnings insight, he highlighted the fact that the reduction in estimates throughout the quarter are much less below the average. I think it's normally like 3.5% they come in. I think he said they're down about 0.5% or so. How do you feel about that as far as expectations heading into these quarters, and especially as we have not seen a lot of downward volatility? You just mentioned it's been more than 380 days since we had a down 2% day in the S&P, and again, we haven't had down more than like a 5-6% from a high in a very long time.
Mm-hmm. So there's a lot of commentary that you'll hear. I've heard it recently, and I think we'll probably keep hearing it through the first half of July, where if the first half of the year is strong, the second half of the year tends to be strong, and we start out the second half with the wind at our backs. And I think that's maybe part of what's going on here. There's some seasonality that's happening here. But to speak to earnings, I believe second quarter earnings, depending on the source that you're looking at, are expected to come in about 8.5 to 9% growth for the quarter. So looking at that, and then looking at what we expect for third quarter earnings, which is roughly the same, and then fourth quarter, which is supposed to be like 17% growth or something. Here's what I would say about earnings in general. And we talked about this on Halftime today, just recently, is that the biggest risk to earnings, I don't think anybody would dispute this. The biggest risk to earnings is that the Mag 7 stops bringing in their part of the puzzle, right? I don't remember how much they were accountable for the last couple quarters, but if Mag 7 gives up or somehow surprises to the downside, earnings are at risk. I think everybody understands that. I don't think it's going to happen this quarter. And a lot of the AI enthusiasm, a lot of the earnings that have driven a lot of those stocks to this point, I don't think we're going to see huge cracks in it this quarter, and probably not even next quarter. So when we're looking at earnings growth, no matter how frothy it seems, no matter how overly enthusiastic it seems, I still think we can pull it off for another quarter. And that's something that through summer, if we're talking about seasonality and we just have these almost optimistic feelings about the market, willing it to go higher, and then you have earnings that come in solid, they don't have to necessarily knock the cover off the ball, but if they come in solid and around expectations, I think investors are going to be pretty calm and pretty optimistic about the rest of the year.
Yeah, and again, this is David Costin from Goldman, and he's saying consensus per FactSet up 9% year over year for Q2, which would mark the highest quarterly growth since Q4 2021. And I thought this bit was kind of interesting. So speaking to that Mag 7, in aggregate, the 6 largest stocks in S&P 500, Amazon, Apple, Alphabet, Meta, Microsoft, and NVIDIA are expected to grow Q2 EPS by 30% year over year, while the other 494 companies are seen posting 5% growth. I mean, that's highlighting exactly what you just said. And again, you said something interesting. I don't expect it to be in Q2, but it really is about Q3 guidance. And it really is about what a lot of their customers are doing on CapEx and whether they're monetizing the spend, right? And so again, we'll see that in the commentary and we'll see it in the guidance. And you better hope you don't see it in Q2 earnings, because that will be the sort of thing that takes the market lower. Liz, you brought some charts about seasonality. I think this is really important. And so as we head into the summer, this week's a great example where there's some kind of important news, but when you have a week like this, where one of the days are closed right in the middle, and we saw this with Juneteenth a couple of weeks ago, sometimes you can get some funky sort of action. I thought Friday afternoon was kind of interesting. There was a rebalancing and you saw some pretty interesting price action right into the close. And, again, a summer Friday, oftentimes, you can get some weird action. Throw some fundamental stuff in there, show some uncertainty about, I don't know, look at the way the dollar's moving, look at the way rates are moving. We're going to hit that. You never know. I mean, the last thing that we haven't seen, we've seen plenty of volatility in commodities. We haven't seen equity market volatility. I suspect at some point that's going to come.
Yeah, well, one of the things that I don't think gets talked about enough is why that weird action tends to happen in summer. There's not as much volume. People are away, especially in the third quarter. When you take July and August into it, you get this period where you have low volume. And if you have even the tiniest little strange action, there's not enough people in the market that day to take up and smooth it out. So that's usually what happens in summer. I would expect that to happen this week. The seasonality stuff, I don't know which chart we sent first, so just pull one up and I'll start speaking to it. Okay, so the seasonality stuff that we sent is actually more about election years. And this in particular, this was in my mid-year outlook. That blue line on the top is this year, year to date. The other lines, the darker purple line is all years, and the magenta line is election years. So there's some seasonality. You hear about this a lot in commentary on TV, where in an election year, you tend to see some volatility in May, you tend to see volatility again in September, October, leading up to the election, and then this sort of relief when it's over. Here's the thing about this year. Look at that blue line, completely outside of the norm. We have totally bucked the trend. We didn't get volatility in May. We had a very strong May. We had volatility in April. So now you're hearing commentary about, well, are we just pulling this whole seasonality thing forward? Perhaps we are. What would that mean then? If you bring up the other chart, if we take it by month, what do months usually look like in the S&P? July is usually a pretty strong month. So the blue shaded part of this chart is all years. And then the magenta is just election years. So if you look at July on the left-hand side of this chart, July is usually pretty strong. I want to be clear that this is 2-week forward return. So if we're talking about today, this is what the return would be 14 days in the future. So July usually pretty strong. Look at that magenta line from early July up until August. Extra strong in election years. So what you might see in summer is, again, this wind at our backs from seasonality, not just because of regular seasonality, but seasonality from there being an election coming up. But then be wary of, look at what happens in September, election years that much more volatile as well. And that just happens to coincide with when we're expecting the first Fed cut. So I think August and September of this year are bound to be a little bit choppier than people are expecting.
Yeah, no doubt. Really quickly, let's just hit the NASDAQ 100, the QQQ here, because again, my view is that if some of that downward price action is going to happen. It's going to start here, and especially when we think about that narrowing of breadth. And it's interesting, from the highs in late March to its lows in April, the NASDAQ 100 sold off about 8%. Many of those big names that we talked about sold off a little bit more of that, but they've come back really hard. Look at the rally that, as of the highs last week, we're up about 18% in the NASDAQ 100. We know that those were powered by NVIDIA and Broadcom and Apple, which joined the party just a few weeks ago. Microsoft has obviously been making new highs. Amazon's at new highs. So again, I just kind of wanted to highlight that when you look at the NASDAQ 100, which is up nearly 18% on the year. And then the other point I'll just make is that let's throw up the Russell 2000 if they can, which is just totally flat, which helps, on the year, Liz, which helps make the case for a lack of breadth.
Yeah, the Russell 2000 thing, not even just a lack of breadth. I think it's a lack of being convinced that we're still expanding in an economy, and a lack of being convinced that growth is going to pick back up and support us, and maybe even a lack of being convinced that the labor market is going to stay strong. So when you look at the Russell 2000, it's that one thing, aside from the yield curve inversion, it's that one thing that even in broadening out environments, even with solid economic data, I continue to come back to and say something's still wrong here. There's still something going on in the market action that is saying we're not in the clear, right? There's still something that is up, particularly in the labor market. As we know, small caps make up about 60 to 70% of the US labor market. So this is definitely something to watch. Now, could it be that this time is different, and this will be the one where if we rotate, it actually breaks out, it's durable, and we get the Tom Lee up 50% before the end of the year number? Maybe, but I think we thought that the last 4 times that it tried to do so.
Yeah, no doubt. Let's take a step back to Friday's PCE number. Again, this is the Fed's favorite gauge of inflation. It came in, a little cooler than expected. And, if I look at that CME Fed funds tracker, it's basically suggesting a 58% probability in September, right? As you just kind of noted, of a 25 basis point cut. And then if we look out to November, we see that it's about a 50% chance that we have Fed funds at 5% to 5.25 at that upper bound, and then a 24% chance that we're down 50 basis points or so on the upper bound here. So looking at that, look at that PCE here, and that's from the daily shot, and that's a great. I don't know if you get that, Liz. It's a great daily sort of thing. It's just kind of a massive chart check on a lot of macro things, but you see where that sits, right, relative to the prior periods or so. Do you think the Fed again are going to move too quickly? Okay, if some of the data, let's say we have jobs at the end of the week, and let's say that's a bit cooler than expected, I suspect that they just don't want to get too far ahead of this and sort of kind of reflate some stuff that they don't want a wage spike spiral. You know what I mean? They don't want commodities to kind of reflate or so. So I don't know, man. I think September is going to be a hard one unless this data really falls off a cliff over the next couple of months.
Yeah, well, if we look at the employment cost index, which is ECI for short, I know we don't have a chart on that here, but if you look at that, it still is pretty sticky. We've made progress, but it's not down. So to your point about a wage price spiral, the risk is still out there. It's lower than it was before, but it's still out there, and they certainly are keeping their eye on that. I think what's going to happen with the Fed in the second half of the year is that their narrative is going to be, they start cutting in September. So let's say we get a 25 basis point cut in September, but then I think they're going to be pretty clear that we shouldn't expect cuts every single meeting after that, and that the cadence will be perhaps every other meeting or as they see fit. But it'll be a signal that, okay, we are not hiking anymore. A 25 basis point move doesn't make much of a difference to the economy. It may make a difference in the market. Stocks might react, yields might react, commodities might react, but it doesn't really make that much of a difference in tightening financial conditions or loosening financial conditions. So I think that that's going to be their party line. Furthermore, I think that there is an increasing risk that as the unemployment rate rises above 4%, people start to get jittery. And if the labor market weakens, the Fed starts to cut rates, and it looks like it's in reaction to a weakening labor market, which is not going to be met with all of the positivity that stocks seem to think cuts will come with. So I think that looking at the inflation data is important. but we've already started to kind of put it aside as, okay, we solved that problem, or it's not as big of a monster as it was before. And then in the last meeting, the Fed moved the goalposts a little bit, increased their PCE expectation for the end of the year, increased their long run Fed funds rate expectation. So they moved it up a little bit to start to get people comfortable with the idea that they're going to cut before inflation is at target. And they may not cut as fast or as far as the market is expecting, but I still think they start in September.
Yeah. So riddle me this though. If expectations are mounting for a sooner than expected rate cut, why is the 10-year yield rallying the way it is? So we have a chart right here. We see the downtrend that it's been in. You see this kind of 1 week price action. And again, yields have been very volatile. And again, it's kind of odd that stocks have not had the commensurate sort of volatility, right? Because normally you see yields up, stocks down. The S&P is kind of really holding in there. What do you think with cooler than expected data? Why are yields rallying this way?
I think this is in anticipation or in reaction to what happened on a debate stage last week, which I don't want to get too far into, but there were things that happened on that debate stage, some good, some bad, most of them bad. And I think the market started to react to the possibility of inflationary forces that could be coming. But I think those inflationary forces still aren't even a story until 2025. So that's why you saw the 10-year move and the 2-year not move that much, because the 2-year tracks what we think the Fed will do. If we thought the Fed was going to hike rates in response to that, I think you would have seen a commensurate shift upward in the 2-year yield, and there just hasn't been much action there.
Yeah. And again, people don't seem to be bothered by the length in which the 210 has been inverted. Again, at some point that might come home to roost a little bit. Let's look at the dollar in the terms of the Dixie DXY here a little bit pressing up against that downtrend that's been in place for the last year or so. You see it's making a fairly nice little pennant formation. Again, if yields were to come in, maybe we see the dollar move back towards that uptrend, which is also the 200-day moving average. I know that we've seen a lot of volatility in currencies that, in the crosses with the dollar of late. And again, I would just say that it seems like maybe it's just been a flight to quality here in the US dollar, given all of the turmoil that we're seeing in some of these other nations that had these snap elections and the like. So talk to me about the dollar here. And again, if we were to see the dollar spike, it's probably going to weigh on US corporate earnings, specifically for the multinationals.
Yeah, that's something that would happen if we saw a sustained uptrend in the dollar again. I would expect it to affect earnings. I think so. There's two things that can happen with the dollar. There's a lot of things that can happen with the dollar, but the two things that I think about most are we in a global flight to safety? I don't think that's the case, right? I don't think we're in this sort of panic mode where the entire globe is piling into the dollar because they're afraid of their own currency. But there have been a number of central banks that have started cutting rates ahead of the Fed. And even though we expect the Fed to do it in fall, those central banks starting to move before us just created an interest rate differential that is more attractive to stay in treasuries for longer. And obviously the rise in the 10-year yield has widened that even further. So I think some of it is that piece where investors have to convert to dollars to buy US assets, and the fact that the interest rate differential probably got more attractive for certain countries. I do think there's also this idea of, yes, the globe has been dealing with inflation. Yes, everybody's tried to fight it, but the US somehow has gotten through it mostly unscathed. And our assets continue to be more attractive because of that and offer more upside because of that. So despite the fact that everybody was dealing with the same monster at seemingly the same time, when you do it comparatively, we seem to be the only nation that has managed to maintain pretty strong GDP growth, a very tight labor market, earnings growth that has stayed quite solid throughout. And I think our assets just continue to look more attractive.
Yeah, no doubt. Let's talk about some sectors that are moving on the yield move a little bit. One of the ones that you would expect to be lower would be the XHB, the ETF that tracks Homebuilders. Talk to me a little bit about this one, because again, down about 11% from those highs, back in the spring. And what's interesting, Liz, is that, the XHB has never confirmed the highs in the S&P 500, and again seem to be, like moving with yields a little bit, which makes some sense. But again, is that the sort of thing that makes you a bit little worried? Because if the unemployment rate was to move above 4% in a meaningful way, you might see the housing market really take a dip here. And so I'm just curious how you're thinking about this group.
Look, trading home builders is not for the faint of heart, especially in a period like this where I think they are trading in lockstep with what happens in 10-year yields. As we know, mortgage rates track 10-year yields. They don't necessarily track the Fed funds rate or the prime rate. So this volatility in home builders, I don't think is any surprise after the big move we've seen in the 10-year. Housing continues to be sticky. It continues to be sticky in demand. And I think your point is the really important one, that unless the labor market really starts to show cracks, I think housing actually stays relatively solid. Now, some of that could still be that people are not willing to enter the market again. Maybe they're waiting for as soon as the Fed starts to cut rates. If we do see a drop in the 10-year yield, I bet there are some buyers that are on the sidelines that are willing to come in and start to take action. But this is a group that, especially in a time like this where we have very little clarity on what's going to happen in the 10-year, I don't want to trade it right now. I just don't think the risk is worth the reward.
Yeah. All right. Let's talk a little bit about some of the big money center banks. JP Morgan, maybe they can pull that one up, is making a new all-time high today. Some of the other money center banks are very near them. Citi, Bank of America, Wells. If one of the big problems that we had during the Civ B situation in March of 2023 and for the balance of the year was just basically higher rates, and what that was the havoc that it was wreaking on some of these balance sheets or so. How do you explain this stock and some of the others? And again, we know they're in good shape. Maybe Bank of America was one of the ones that people were a bit more worried about, but the commentary out of Jamie Dimon when the company reported their Q1 results, and a couple times since then, wasn't particularly great. We had that huge gap on April 12th, and then when they reported, down 6.5%. For JP Morgan, that was massive. So how do you explain, with rising rates now over the last week, to see this sort of move that we've seen in the last week and a half, with the 10-year yield going from 4.15 to almost 4.5%?
Yeah, well, along with that move, you saw the yield curve inversion go from about 50 basis points to 33 basis points.
Mhm.
So there has been some what would be called twist steepening in the curve. And as that curve, if it's on a trajectory to normalize, that does actually help banks in the long run. Regional banks, however, you mentioned the regionals before. Regional banks are much more victim to what's happening in that yield curve inversion and what's happening along the curve. That's not to say that big banks are not vulnerable to it, but they have a lot of other stuff going on. There's a lot of capital markets activity that they can lean on. There's bond trading activity that they can lean on. We've got bond spreads, investment grade and high yield, that have remained incredibly tight. So there's a ton of demand in the bond market. It seems to be functioning just fine. And you've got obviously a stock market that has risen more than anybody expected in 2024, which is increasing that capital markets activity, that IPO activity, that M&A activity. And some of these banks can benefit from that. There are some banks that are more exposed to the consumer than others. And I'm talking about big banks. There are some of them that are much more exposed to the consumer than others. So if the consumer continues to show cracks, and I'm saying continues because it's already happening, if consumer credit continues to show cracks, I would expect there to be a little more divergence in the performance of these big banks, and for the ones that are more reliant on consumer lending to see more trepidation in their stock price.
Yeah. So when you just talk about the strength in the stock market here, I just want to kind of throw this up. This is from Seeking Alpha. This is U.S. sector performance in the terms of, these sector ETFs. And I think it's pretty interesting. Obviously, communication services and technology both up about 17.5% on the year. And then when you just kind of go down, financial services, 9.3% higher, energy, nearly 9%, utilities up 7.6%, industrials, 6.9%, healthcare, 6.9%, staples, 6.3%, basic materials, only up 3.25%, consumer discretionary. This is an interesting one, 2%, because we've seen some consumer confidence data that's kind of hanging in there a little bit. And then real estate down in the year. When I look at consumers discretionary, Amazon's the largest holding. Tesla's number 2. Then it's Home Depot and McDonald's. Home Depot, McDonald's down in the year. Tesla's, of course, down in the year. So again, this also speaks to the lack of breadth. And if you look at where the outperformance is coming from, those top 10 tech names or so, any of these sectors, Liz, you want to kind of pick at if we were to have a 5 to 10% peak to trough decline like we had last summer into the fall?
Well, my final trade on halftime today was energy. I would definitely pick at that. I've talked about this before. It's in my mid-year outlook. This is not a call for defensives, but when you have a steepening yield curve environment, the sectors that tend to do well, energy is one of them. The others are utilities, staples, and healthcare. Part of that is because they pay a decent dividend, and in a steepening yield curve environment, you typically see the short end of the curve coming down, so you're not getting paid as much on cash. You want to get paid in other ways, so you want to look for dividend stocks. So I would say even a dividend stock ETF, if we get a pullback, a dividend stock ETF might be a good entry point too.
Yeah, so it's interesting. We talked about the pullback in the XHB. Let's pull up the XLU for a second here, because this is one which is kind of benefiting oddly, well, not oddly, but to some degree of this AI trade and the power consumption and the like. And then I want to pull up the IYT. This is the iShares US transportation. Again, never confirmed a high over the last couple months in the S&P 500. Down about, I don't know, close to 10% or so. The XLU is down about 7%. So there's some stuff under the hood that just doesn't act particularly well. Doesn't mean, again, that communication services and technology can't continue to rally here. All right, let's look at a few single stock names. I'm not asking you to opine on them one way or another, but I think this will be really interesting. Tomorrow morning, Tesla is going to report its Q2 deliveries. Now, here's a number that has been coming down all quarter. And so again, I think it's interesting. Let's look at the 1-year chart really quickly for a second. Expectations are pretty low. You see those moves from those highs there about a year ago, and there's a number of instances where it's kind of tested that downtrend that's been in place. The average kind of rally off of those lows we've seen, it's probably about 35% or so. If we had a 35% rally from those recent lows, that probably gets you to 230-ish or so. And then if you take a look at the 5-year off of the 2021 highs when the stock was near 400, it's interesting that a 35% rally or so gets you to about $231, which is basically right where that downtrend is. And our main man Carter likes to say this, to the penny. I mean, I just put that line on those relative, lower highs, and it is amazing how it has gone to the penny. So the point I would make about Tesla is if you don't see a number much worse than, let's say, the whisper as it relates to deliveries, then the stock probably continues to move. It just got through its 200-day moving average today, probably gets rejected around 230 or so at that downtrend. So Liz, what do you make of, if you think back to about a month and a half ago when NVIDIA reported, when we placed too much emphasis on one stock and their earnings or their guidance or their commentary, as a strategist who most focuses on, sectors and the broad market indices, what do you say to yourself when you're sitting there on the halftime report or you're listening to us kind of wax poetically about some of these big names? Do you say to yourself, that's just a bunch of noise?
I don't think the big names are a bunch of noise, but I do think it's dangerous when the entire market is trading off of a couple results from those names. So there are some rules that I try to stick by for myself. I don't trade before big reports like that, because if you get it wrong, you end up positioned on the very wrong side of that trade. And that isn't just for individual names. If there's an entire group, so semiconductors, for example, that is completely victim to what might happen in an NVIDIA earnings report, I'm not trying to trade the semis ahead of that and speculate that much, because there's just too much sensitivity. So some of these things, you get the big report, you get the big headline, and I think it's usually best to wait for that headline to sort of fizzle out, let the market to react to it, let that particular stock react to it, let the industry group react to it, and come back to its senses into a place that, and I don't know if it'll be higher or lower, but trying to trade beforehand, I think, is a risky game.
Yeah, so to make that point, let's pull up the SMH, the ETF that tracks a semiconductor index, and NVIDIA is about 20% of that. Taiwan Semi is about 13% or so. And it's interesting when you look at those uptrends that have been in place from the October lows, you look at the breakout levels from, I guess that is in May or so, you look at how far above the 200-day moving average it is, you say to yourself, this could easily come back in to that uptrend that's the October low to basically, where we are today. That would be probably another 10% or so. And again, let's look at the NVIDIA. This thing had a nice little pullback as the S&P did not pull back a whole heck of a lot. At one point, I think it was down 15%. If you look at where that breakout level and where it comes into play with that uptrend that's been in place really since the start of this year, you get to about $100, right? So this was a stock trading at 140 just a couple weeks ago. Analysts have been tripping over themselves to raise the price target. You think about how much market cap this stock has gained in just a few months or so. I think it's about $1 trillion. And you think about the deceleration that's expected to happen, over the next few quarters or so. This one, again, I've said this again and again, and I've been wrong here and there. But it seems a bit dicey if you're trading this off the next quarter's expectations, because they're just going to have to put up routinely bigger than expected beats. So Liz, you were gone last week. So we saw this rotation. Maybe they can pull up the IGV, which is the the software ETF. So you saw money come out of major semis and into, let's say, some of these, enterprise software, some of these SaaS names. And it's interesting because, there was a bunch of gaps that were happening on the earnings season. You see that gap that we had about a month and change ago. And here we are. We just had this big power move. How do you think about semis into software? And ultimately, do you think that they end up moving together at some point in the not so distant future?
I actually think, and I believe I talked about this a few weeks ago, that the underperformance of software compared to semis, software would be one of the first spots that would be a beneficiary if people started to get worried about the valuations in semiconductors, or just even the movement that we saw in semiconductors. It's just rational for any investor to look at that in their portfolio and say, you know what, that's a pretty big gain over a very short period of time. I'd like to lock it in and just take some of those gains. But those are investors who probably want to still be exposed to tech, still want to be exposed to the theme as best as possible. So they rotate into the closest cousin of that, which is likely the software names. And I think that's what we're seeing recently. This happened earlier in the year too, where we had a rotation into what people were calling the old technology names, where there wasn't really any news, there wasn't any fundamental change that happened, but it was money that just wanted to stay in tech and go into something that had a more attractive valuation. So do I think they'll trade together at any point? Not unless we have another big multiple expansion move, which I think some people would say is going to be that first Fed cut. Maybe that will happen initially at the first Fed cut, but that's how I think they move together. Usually semis and software, I chart them quite often against each other as a cyclicality signal. And typically when semis are outperforming software, you have stronger cyclicality. Same goes for discretionary outperforming staples. So I wouldn't expect them to move together in the near term.
Yeah, it's pretty fascinating, the haves and the have-nots in the semi space. We have a quick chart of AMD, and again, February into March, the stock was raging as it really sounded like they had some chips that might be able to compete on the GPU side with NVIDIA. And look at how this stock has traded. I think it's right about to break that uptrend. You see that 200-day moving average. I think that's pretty interesting. All right, Liz, let's take a couple questions if you have the time to do that. So again, this is from Lawrence Giordano. We kind of hit this a little bit. Why is the bond market getting hammered? Breath horrible, yet the S&P is up. So again, the bond market getting hammered, do you think that has a lot to do with, again, some of the differentials, or is it something that, I know we kind of hit this already, but it seems like one of those things, the difference between how the stock market is acting and the bond market, if we were to go back towards 4.75 in the 10-year, and let's say the 2 doesn't do a whole heck of a lot, is we're still expecting, let's say, a 58% chance of a rate cut in September. I mean, something's got to give sooner or later, Liz.
Yeah, and the 10-year has been a pretty big head scratcher for a lot of investors, self-included, for a while here. So if you look at, just that trend channel there, right? It's still downward moving, and then this will be the second time that we've had an attempt to break through the upper part of that trend channel. I don't think that we're going to break through it unless we have some kind of news of reheating and inflation or some kind of jobs data that's incredibly tight, much tighter than we expected. I think that this is a reaction, again, to some of the debate news from last week. I think this is in anticipation of possible inflationary policies that could go into effect in 2025. I think some of this will be given back. It was a pretty quick move upward, and I even see a little gap there. It was a pretty quick move upward. I think some of it will come back down over time.
Yeah. All right. Here's a question. This is from Scott A. What does Liz think of the GDX? And just really quickly, so this is the Van Eck Gold Miners ETF. And it's interesting when I look at the chart, just really quickly, purely from a technical standpoint, maybe they can pull up a 1 year really quickly here. And if you look at just there's support right in this kind of 33-ish level here, if you were just to draw a line from the high a year ago, and you see where this ETF is trading right now, and it looks like it's making a little top. And so this is the miners, and maybe they could pull up the GLD for a second, give you a little time to comment on gold. And if you look at the kind of breakout that it had from February up to those highs or so in April, and you see the consolidation that we've seen, what do you make of the miners' action on a relative basis, I guess, to gold?
Mm-hmm. So a few months ago, and full disclosure, I own GLD and GDX in my personal portfolio, but the timing of them was different. So when I first put a position in GLD, I also own PHYS. When I first put positions in those, it was because of some of the stuff that was happening in Japan. Some of those positions I've had for a long time because of central bank volatility and just uncertainty around it, and a lot of the currency behavior that was happening that didn't sit right with me. So the gold positions had been there. And then we saw this huge run in gold, and the miners hadn't kept up. So the GDX trade was a catch-up trade, figuring that as gold continued to run up, the miners would have to catch up. And they did a little bit. It happened a little bit. It didn't happen entirely. And now both of those charts are doing sort of the same thing. I wouldn't even say that they had a drawdown. They just sort of stopped moving upward, and now they're moving sideways. But there has also been a pause in some of the news out of currency land. We haven't had as much FX volatility as we had a couple months ago, and as much concern over maybe what Japan was going to do, how they were going to save their currency, and what they were going to do to save it. So this may just be a little quiet period. I have not exited anymore. I did trim some gold positions, not gold miners. I trimmed some gold positions a few weeks ago because the gains had been so big. And I think it was on a show with Guy that I talked about this. I trimmed them because gold is something that you don't typically see up in your portfolio 24% over short periods of time. So when you get a benefit like that, it was just time to take some profits.
Yeah, no doubt. And again, like just going back to the dollar, it's been moving a little higher. So that should put some downward pressure, I guess, on gold. All right, Liz, I really appreciate you being here with us. I'm going to drop you. We're going to say goodbye. We're going to say early happy birthday. So thanks for being here.
Thank you. Bye, everybody.
All right, really quickly, I just want to hit one name. Hold on. Sorry about that. Here's a question on Nike, and this is a stock that had its worst day, I don't know if ever, but in many, many decades. And this is coming from Jack CF. Lulu, a buy or sell after Nike earnings. And I just want to hit Nike for a second here, because this is one on Thursday's Fast Money. I'm sitting there at the desk, and I just want to say this. I think I've said this before. We have this thing that we've been doing forever. I think we do it on Fast Money, and we also do it on the halftime report. It's the one segment that I hate the most, and it's the final trade. And oddly, it's one of the segments that Amanda's listening to me, because she was our producer for many years, and she heard me kind of bemoan this a little bit. It's just a 45-second block where four people have to go around the horn and give one like stock recommendation or something like that. And I kind of hate it. I usually kind of put a little bit of a check on it. And we're talking about Nike, and we're talking about the guidance that the company gave. And, you know, again, I just didn't think it was horrible. I didn't think it deserved to be down, let's call it 15% on that. And when the stock was $83 at 5, 59, I said, listen, you could probably buy this thing and use an 80 stop to the downside. Okay. And when I'm doing this, if you're trying to pick a bottom in a stock like this, you really want to trade with stops, because, who knows where this thing could go. Aftermarket action is obviously, and this one was high volume, but it's going to be much less volume than you have on the opening the next day or so. And the fact that the stock traded down 20% on Friday, and it's up a little bit today, you probably want to give it a little time. If they could pull up a 5-year chart or so, if you just look at that sort of COVID low in 2020 that went down to $60 and it had that epic move, up to 180. I mean, this is the sort of stuff that really freaks me out a little bit, that sort of price action could happen. And here we are now with the stock at $76, down more than $100 from those 2021 highs. This is not some, overpriced, internet stock that saw a huge pull forward, or a fintech of some of that behavior. I mean, this is Nike. They have the Euros going on right now. They have the Olympics that are happening. Those are seasonally usually pretty good periods for Nike. So this one is in kind of no man's land right now. And again, I think they probably kitchen sinked the guidance a little bit. And we know that, Donahue, the CEO, is going to be under a lot of pressure. And I would almost say that this is the sort of name that you might see an activist kind of get involved in. So again, if this stock doesn't fall out of bed from these levels and consolidates a little bit, one of the things we were talking about at the start of this program was how a lot of these companies that had huge earnings gaps, right, in early Q2 after the Q1 earnings, most of them filled in a good portion of those gaps. Okay, so back to the question about Lulu. I mean, this is one where this stock was trading over $500. This is at the start of this year. Here we are at about $300. And I look at something like this and I say to myself, okay, these guys are very differently positioned as it relates to Nike. And when you look at their geographic exposure around the world, China was a real problem for Nike. These guys don't really have that exposure. I'm looking at consensus estimates for Lulu and 2025 fiscal year, 12% expected earnings growth, about the same next year. Revenue growth expected to be about 12% this year, about 11% next year. Trading at fiscal 2025 at 21 times and 19 times next. I mean, this stock for I don't want to say cheap, but trading at a market multiple with double-digit earnings and sales growth, this is about as cheap as this stock's been in a very long time. So again, unless you think there's some massive issues as it relates to style, as it relates to competition, as it relates to margins. I mean, I'm looking at the margins here. They had a huge, kind of up, I don't know, like 3% margin increase since fiscal year 2023 to this year, expected to be about 48.5 or so, and basically expectations for flat next year. I mean, this stock does look like a buy, and maybe it's the sort of thing that you start kind of picking at a little bit. And again, maybe more so than you would with Nike when you think about how much this stock has come in such a short period of time. Obviously, Nike from $525 down to $300 is probably on a percentage basis more than what Lulu has done. But again, that percentage looks kind of interesting to me. The sales and earnings expected growth versus the multiple also look interesting to me. All right, we covered a lot of ground here today. I want to thank Liz Thomas again. We got a little update on her honeymoon. And again, if you guys are planning a big vacation abroad, I would say this: rather than sitting on a beach or a ski trip or something like that, going down to Peru and checking out Cusco and Aguas Caliente, and also, and again, we're not getting plugged by the Peru vacation authority or anything like that, but it is a really cool place. So thanks to Liz, thanks to you guys for being here, thanks to our sponsors FactSet and SoFi. I'm going to be back tomorrow with Carter Braxton Worth. We're going to do a whole heck of a lot of charts, so come back, be here with us. Oh, one last thing: if you like these pods, you're sick of our voices, we have a great pod that we introduced about 6 weeks ago. It's called the Market Matrix. That's MRKT Matrix. Our team, Guy, myself, and the rest of our peeps, we take about 10 stories, we summarize them using one of these large language models, these interfaces. Usually it's Perplexity. We take the summary and we take the text and we put it into a voice bot, and you get a pod. You get the most important stories under 10 minutes. Go check it out. Go follow it, rate it, review it. That's how you can help us out here. This thing's gaining a lot of traction. We're pretty excited about it. I think you're going to like it. So check it out. All right, peeps, thanks so much for being here. We'll see you tomorrow.